But coming back to your question, so far so good, strength. But I actually think we're overbought in gold, and all the sentiment is bullish. And I'm certainly thinking higher prices, as I just stated. But for the record, I think we could get a pullback here fairly soon. The reason for that is sentiment, technicals, and also there's a propensity in all the futures markets and all the commodities to resist round numbers. And a round number for gold is 3,000 USD. I know we're at 4,000 and beyond in Canadian dollars, and many other currencies were at all-time highs. But the dollar is the market that's watched by most. And that number of 3,000 may not be breached the first time through.
Gold is currently overbought, and while the speaker, David Morgan, expects higher prices ahead, a pullback could happen soon. Sentiment is extremely bullish, and technical factors suggest a short-term correction. Markets often struggle to break through round numbers. For gold, 3,000 USD dollars is a key psychological level. While gold has hit record highs in other currencies, the US dollar remains the primary benchmark, making $3,000 a potential resistance point on the first attempt. David Morgan is a well-known expert in the precious metals industry, particularly silver. He explains the recent surge in gold was sparked by tariffs, creating an arbitrage opportunity between London and New York. Short sellers with physical gold must ship it to settle trades, contributing to the rally. However, history suggests that the market tends to cool down in the following weeks or months after initial excitement. David exposes gold as a much deeper market than silver, with significant central bank holdings. If a bullion bank faces delivery issues, a swap with a central bank could temporarily resolve the problem with either paper or metal repayment. Given the interconnected nature of the precious metals market, such swaps have happened before and will likely occur again. David highlights that the gold-silver ratio remains above 80, indicating that silver is lagging behind gold, which has reached multiple new highs. Historically, silver tends to follow gold's lead and eventually outperform on a percentage basis. While a significant surge may not happen this year, a drop in the gold-silver ratio to around 70 is still a strong move for silver. Looking back, the highest recorded gold-silver ratio was over 125 to 1 in March 2020, during the market turmoil caused by the global crisis. This extreme level was short-lived but presented a rare buying opportunity for silver investors. Despite silver's underperformance, history suggests it will eventually catch up to gold. As we present clips from the video, please like this video, subscribe to the channel, and turn on the notifications bell to be instantly notified every time we upload a video. Thanks for the support and enjoy the video.
Well, both. I think this tariffs is definitely what started the run to gold. And there's an arbitrage opportunity where you have a differential between London and New York. So if you're going to cover your short and you have the physical metal there, we have to have it shipped in order to accomplish that, and that's what's been taking place. Will we get a big rollover in the subsequent months? Yeah, I think we will. We've seen this happen a few times before, not to this level, at least to my recollection, but usually everyone gets very excited, everybody gets on one side of the boat, and then as the days and weeks roll by, it subsides. I think that's probably the most likely case, but it's yet to be determined. Further, the gold markets is a much more vast market than the silver market. It's deeper, and you've got a lot of central bank holdings. So let's say, for an example, or as a thought experiment, there was a bullion bank that was behind the eight ball, so to speak, and they needed a delivery. It wouldn't be surprising at all to see a swap take place with the central bank, take the physical gold, put it into place so there's no, problems, and then that swap will later be paid back, either in paper or metal itself. I'm not saying that that's a given, but it's certainly happened in the past and certainly could happen in the future. And because, again, gold market is pretty deep, you have a better opportunity for that to take place than you would in the silver market. But regardless, both of those markets do have, let's say, a tight-knit community that can work together at times. Silver has been disappointing. I mean, if we look no further than the gold-silver ratio, that tells us the story. And because gold has made so many nominal new highs and silver has not, and the gold-silver ratio is well above 80, that's just suggesting that, silver's lagging, and it is. I think it's not only has it underperformed, say maybe last year where it's been a little bit better than gold, but I do think it'll catch up. I mean, it's not untypical for silver to fall behind, let's say, gold's lead, and all of a sudden it takes off and it definitely catches up and overpowers gold on a percentage basis. That's what I do think will happen. I'm not sure it'll actually happen this year, although it could. I do think that this year silver will outperform gold, but not in a real substantive way. So, for example, if we got the gold-silver ratio to 70 this year from, well above 80 right now, I would consider that a win. I started the Silver Investor website and, rebranded the Morgan Report many, many years ago. But at the time I started the first website, the gold-silver ratio is about 80 even. And really, Elijah, at that time, I thought that would be the highest gold-silver ratio that I would see from the year 1999, 1998 when I started the website until present. Obviously, I would have been wrong. We've seen well over that, not only recently with gold making new highs, but you go back to when the illness broke out in March of 2020, and we saw really, for my records and many others, probably the all-time high gold-silver ratio, which is over 125 to 1. It didn't last very long. It was a spike. I actually was lucky enough to buy silver within a few days of that actual high gold-silver ratio, meaning you were getting, a lot of silver for your gold if you were swapping, or a lot of silver for your fiat at the time.
In an interview at Liberty and Finance, David points out that the silver and gold markets operate in two distinct spheres, the retail and the derivatives markets. The derivatives market, primarily driven by COMEX, sets the benchmark price, influencing all other silver prices, including retail. While retail silver prices fluctuate based on supply and demand, the futures market has historically dictated broader pricing trends. However, recent developments suggest that physical silver demand plays a more significant role in setting prices, as institutional investors and industries drive the market. This shift has led to arbitrage opportunities and potential backwardation, where spot prices exceed near future prices due to immediate demand. David suggests that despite the influence of physical demand, the futures market has mechanisms to prevent defaults. If a trader stands for delivery but silver is unavailable, they can be compensated with cash, as contract terms allow for cash settlements. This means that even in tight supply, COMEX cannot technically default. While this has happened before, investors must understand that accepting a cash payout instead of physical metal is a built-in market feature. However, the ongoing shifts in market dynamics raise questions about how much longer the paper-driven market can sustain itself against increasing physical demand. Now, let's get back to the interview.
So there's really two markets. When I say the silver market or the gold market, I'm talking about the derivatives market, which is the price set by the COMEX. And even though it's a price of a derivative, all other prices gear off of that price. So in the retail market, that's a separate market from the futures markets. And that market, which is substantive, does not set the price in the futures arena. The futures arena sets the price in the retail market. So if the retail market is very tight, then you will see huge premiums like we saw not that long ago. I mean, Miles Franklin and on all the dealers were selling silver eagles at, I think at one time, like a $14 premium or something, because that particular market was extremely tight. Lots more buying than selling. Now we have the opposite. Most of the retail market, it's you and I, it's the stackers, it's individuals that buy silver and gold, have basically got all they want, or they've got to pay a bill, or they've given up, or any combination of reasons. And they're being net sellers, basically, and there aren't much buying in that realm. On the other hand, when you look at the derivatives market, which usually isn't used as a delivery mechanism, it has been. You've been seeing the silver moving out of the SLV as an example, silver moving again from London, New York, and then delivery taken out of New York. We've seen a lot of movement in the physical in that market, meaning 1,000-ounce commercial bar market in silver and the kilo bar, 100-ounce bar market in New York and London usually has 400-ounce bars, which could be converted to 100-ounce bars. So regardless, it's something that's very different. Most of the time we're really, even though we use the word silver, we're talking about the retail silver market. But really, I mean at all times the derivatives market. Same thing with gold. And this is the distinction between the two. And what's interesting is to see that we'll call it the industrial or institutional side. So it's either large industry and or institutional investing is driving the market. And that's really the purpose of the futures market. So we're really in a place that's kind of where it started out, meaning that instead of the tail wagging the dog and the derivatives price determining how much silver ebbs and flows, we're in a position now where the actual physical market, at least greater than normal, is setting the price out there. And that's why you're seeing this arbitrage opportunity and potential for backwardation where you have to pay more at spot price at today's price than you would in the near futures because it's demanded right now. And so it's very interesting to watch this unfold, Elijah, because that's the true market. And if that market were to break, then it would be most interesting to see what the authority figures would actually do. Technically, and for the record, you can never default on the COMEX. The reason being is the contract says that a cash settlement is final settlement. So for an example, if someone stood for delivery and they were given a check and said on metal, 1,000-ounce bars, there's nothing you could do about it. You've already agreed when you signed your futures contract, be you, a speculator or a large institution, regardless of the same contract, the same rules apply, and you couldn't whine, cry, or do much about it. You might post it on the web and say, hey, I wanted to stand for delivery, but I got a check instead. But if you know how the market works and what the rules are, you kind of have to blow it off and say, well, you're the one that knows you're going to get paid one way or the other. And then that's it.
While gold and silver markets are influenced by both physical and derivative trading, shifting demand dynamics suggest a growing role for actual metal transactions. With gold facing potential resistance at $3,000 and silver historically lagging before surging, investors should watch for potential corrections and opportunities ahead. The evolving relationship between physical demand and futures pricing will determine market trends. How might central bank actions impact the gold and silver markets in the coming months? What factors could drive silver to outperform gold shortly? Share your thoughts in the comments below. Also, remember to like this video, subscribe to the channel, and turn on post notifications to stay updated with more content like this. See you next time.